Hello traders. What I want to speak to you about today is something that's been playing on my mind for the last couple of weeks or so regarding what's going on in markets with all this virus stuff going on, what's happening to the economies, what central banks are doing, everything like that. And the main thing that struck me over the last few weeks or so is that we're seeing a lot of people sort of trying to apply historical thinking to this situation. And in my aspect, that's a wrong thing to do because this is a completely new scenario. What we're seeing here with this virus is completely different to anything we've gone through before. A lot of comparisons are made with a global financial crisis. Again, I think some of that is a wrong comparison to make because this situation really has come out of nowhere. And it's not structural, it's not fundamental, it's not driven by excesses in the banking sector, over leveraging, excessive debt or anything like that. It's a health crisis, and even though the effects are the same, how it's impacting economies with the shutdowns and everything, you can't tie them together with what happened in the GFC. It's completely different, and that's throwing things right up into the air. But as I say, what I'm seeing and hearing, when you listen to the market and listen to the market players, is trying to apply those historical lessons from the GFC to this crisis. And I think that's wrong, and I'm going to run through a couple of reasons why I think that's wrong. The first thing is, as I say, it's completely fundamentally different virus. This is a health issue. It's not driven by anything fundamental, structural, cyclical, or anything like that. And we can't stop it. No matter what the central banks do, no matter what the governments do, throwing money at it, programs, whatever, it's not going to stop the virus. The virus has to play out as it will play out, and whatever that means going forward. What that means for us trading and what that means for markets is that we're seeing a completely different way of looking at things. The market doesn't know what to do with it. We don't know what to do with it. And to give you an example of that, even the moves that we saw over the height of the fear and the worry about the virus are completely different to what we saw over the GFC and the banking crisis and everything like that. If we look at a simple chart of the euro dollar, we can see that, way back when things started kicking off, 2007, 2008, the initial months on after that event and when the Lehman's crisis and the subprime crisis, everything kicked off, we had moves, thousands of pips, 2,000-3,000 pips. As you can see by that blue arrow on the chart right there, over the immediate impact months, if you like. And here we are, again, looking at this thing, and we've seen panic in the market. We've seen economies shuttered, and, the expected impact is going to be double, triple, quadruple what happened over the GFC. Yet we've only seen the initial reaction, some in FX anyway, less than 1,000 pips. We've just over, maybe just even about 800 pips. If you look at that 2-week period over March, you can see that by the small arrow on the chart there. And now we're just in this sort of what next mode. And the reason that's different is because what happened over the GFC was that this caught the market on the hop, it caught governments on the hop, it caught central banks on the hop. And so we had years of regulation clamping down on excess debt, non-performing loans, all the stuff, the bad stuff that the banks were doing, all got compacted, all got regulated, and that's what's happened over the last 10 years. All to put banks in a much healthier position, to put the financial system in a much healthier position. And that's fine. To a certain extent, that's worked. But here we come with something like a virus where basically the whole world has effectively stopped, or huge parts of it, 90% of it, has just come ground to a halt. And all those procedures that central banks, governments put in place, they've stopped a crisis, if you like, but what it hasn't fixed or what it hasn't assessed is the flow of money going around. And that's been the biggest impact for banks now. So, rates have been cut to zero. QE's been restarted again. Governments are throwing, debt levels out the window. They're just hammering it, hammer and tong. And what that's done is that's kept the system moving, because there was a big liquidity problem at the start of this thing, and I'll come on to that in a moment. But what the central banks have done via all their old programs, be able to start up those really quickly. It's not been a case of, what do we do, and design these tools, design QE, like it was back in 2012 and before. They've got all these programs ready. They were all in the toolbox. So bang, in the space of 2 weeks, we had rates cut to zero, QE started, you name it, kitchen sinks were thrown at it. But again, the fundamental difference is in this crisis is that it's come because in a really short space of time, economies shut. And then what happened was, as I say, it was a liquidity issue because the flow of money stopped pretty much instantly. And obviously you need people have to pay bills, people have to have money flowing around the globe. It happens all day, every day. There's just a complete flow of money around the globe. So if big parts of that stop, then it becomes a liquidity issue. And that's what central banks fixed, if you like, or acted upon in the first instance. As we saw in emerging markets, currencies were getting sold off. There was a big demand for dollars, a big dollar shortage, as people were saying. And so that part of the equation was fixed by central banks providing swaps, increasing liquidity to the market. But where that's impacted mainly has been in stock markets. If we look back a few weeks ago to when it was all really volatile, it was stock markets that really came in it. You got the Dow jumping 800 pips one day, falling 800 the next, down another 800, really, really wild moves. And as I say, the Forex markets were relatively steady. I say relatively steady. We had pairs like cable, falling from near 130 all the way down to 115. Quite sharp moves, but then that was a very quick move in essence, and it's come back up again. And as I say, from looking at that euro dollar chart, it really top to bottom was around 800 pips. That's not a lot. It was mainly stock markets that were going, even gold was going, but also throw into the mix the oil markets as well, everything that was happening now. So really, we're at this position now where in FX markets we've had pretty much all the volatility at the moment that we've seen. We had the big risk, the big shock factor back in sort of March time where we saw those volatile moves, but things have calmed down now. And what we're into now is the period of we need to see what's happening with this virus. And this to me is the biggest key point. It's the timeline factor. Central banks have acted, governments have acted or still acting even, and everyone's getting ready to fix the issues that are going on right now with people being out of work, with the economy shut down. But the difference to the financial crisis, might be the banking crisis and everything back in the 2008, 2012, whatever, is that we don't know when this is going to end. At least with those periods, there was a problem. The problem got fixed over a period of time. Once the fixes got put in place, then we saw things start to get back to normal. We don't know when the fix is coming for this. We don't know if there's going to be a vaccine. We don't know whether the vaccine is going to work. We don't know how long the vaccine is going to take. We don't know how long governments are going to keep countries shut down, restrictions. We're seeing some countries easing restrictions, very lightly. We don't know if that's going to cause a second wave of the virus. There's so many unknowns to this. You cannot really look at history and something like, the financial crisis and say, right, well, we can take the rules from that and overlay it on top of this. It may be the same in terms of reactions, how markets move and how economies move. But fundamentally, the reasons behind it aren't the same. And that marks a big difference for me. And as I say, it's really a timeline thing. This is the key point. If we don't know that, we don't know what to do. We can't plan. We can't say, okay, well, in 6 months' time, governments are going to do X, Y, Z to boost the economy, and then the market starts trading the expectations for that. Because we could get 6 months down the line and the virus is still floating around and still causing problems, and then governments can't do that. So, as ever with markets, what we trade or what markets trade is always expectation of what's happening next. We very rarely see a lot of trading these days on what's happening right now. Everything is about what's next, what's next, what's next. We saw it over with the Fed. When the Fed were going to taper, we had the taper tantrums. as they called it, and then the market was like, well, when they're tightening that, when are they going to move to rate hikes? How far is it going to come down? How quick is QE going to stop? When are we going to go to rate hikes? So on and so on. So the market's always looking ahead. And as I say, the problem we've got right now is that we can't look ahead because we don't know how far we're looking ahead. So what can we do as traders if we don't know what's happening over the foreseeable future? If we don't know what this virus is going to do, when's it going to stop, if it stops or whatever, how do we trade it? How do we plan ourselves what to do over these markets? And it's pretty simple. When you come down to it, as usual, you bring it down to basics, bring everything down to the basic steps. And the basic steps is prices go up, prices go down. Doesn't matter what the crisis is, what's behind it, what the driver is. Doesn't matter if it changes 1 minute, changes another minute. Prices can only do two things. They go up or they go down. So if we can't look at anything over a 6-month timeline, if we can't plan ahead, if you're a fundamental trader such as myself, the fundamentals are important, looking at the data, seeing the signs of when things are going to change. If you can't do that, then we have to, in a way, discount that, and we just have to go to simple price action. And if that means trading the short term, you just pick your levels in between and pick a fairly tight range, then that's what we do. The charts are there to show us where the ranges are. As I say, with euro dollar, an 800 odd pip range over the high and low of the panic, if you like, that we saw in through March. Well, there's a range in itself. You've got the low points, you've got the high points, and they're pretty much within recent long-term ranges anyway. So there's nothing really changed there. So we can look at the charts, we can find our ranges, our wider ranges, if you like, that we know if these wider ranges break, then something is changing in the market. But if they don't break, or if we trade in between, then we can pick a range in between, look at the range in between, and just look to trade that. We take things back to the very basic and simple level. We've got tops, we've got bottoms, and you trade in between them. So that's really what I'm looking at, how to trade it. And what I'm looking at is, if we're going to look at the detail of it, the minutiae of it, is seeing what's changing. Why is markets, why is the FX market pretty tight at the moment? Why are we not seeing really big ranges? Or we saw the big volatility flows going through, and now things have settled down a bit. Again, we've got people in the market, economists and analysts, they're saying, okay, well, central bank's doing this, and this central bank's doing that, and this government's doing that. And you'd expect prices to move on the rate divergence trade or the fundamental changes. But again, that's not happening now. That rule of thumb doesn't work at the moment because everyone's in the same boat. We know economies are going to crate up. We know economies are going to be bad. So it doesn't matter whether there's 5 million unemployed in the US 1 week, and there's 3 million in the UK another week, and there's 10 million in Europe a week later. Those numbers don't really matter because everything's bad. It's all bad. It doesn't matter whether it's really bad, extremely bad, or just a little bit bad. It's bad, and we can't change that. So what's happened is we got interest rates all down at zero or being cut still across the globe. So for FX markets, we've not got that rate divergence. It's pretty much a zero-sum game. So when you see a big data point come out, Eurozone unemployment has just jumped to 10% or whatever it was, it doesn't matter versus the US unemployment because that's going to be bad anyway. So there's no rate divergence trade at the moment. All the central banks have thrown all their big tools out on the table. So at the moment, all we're going to be trading is maybe tinkering around the edges. So the rate divergence trade is out the window. Again, that's one of the fundamental things, the rule of thumbs that we always use in these situations doesn't work. So again, we get back to the simplicity of trading. The simple things we do is watch the prices, pick your price levels, pick your ranges, just trade in between that. And then maybe, just maybe, we start to see things get factored in if we start seeing vaccine news coming up, if we start seeing economies lifting restrictions and there's no jump in virus cases. Those are the types of things we want to look for to then start thinking about the future, seeing how markets are going to recover in the future. So what's going to happen is that when we get headlines like that, as we've seen, if we suddenly get good headlines about vaccines and restrictions being lifted and it's not having an effect, then the market's going to start jumping ahead, doing what it does, pricing expectations going forward. And that's when we might start to get a bit more volatility in some of these wider moves and ranges being broken. But until that happens, we still got to focus on what happens now. And again, it comes back to the timeline. We could be here, let's say 6 months from now, in the same position we are in now. What's that going to do to stock markets? Our stock market's going to continue ranging, bolting higher by 400 or 500 pips every time there's good news and dropping 800 pips every time there's bad news. What I'm basically saying is I don't see any trends. I don't see where you can pick a start of a trend and ride it all the way, because that news that you need to come behind it to build on the trend isn't really there at the moment. So basically, to sum it up, it sounds like I'm making a case to I haven't got a clue what's going to happen in the future, but unfortunately that is the way things are at the moment, and that's the situation we are in. You can set yourself up for maybe a long-term trade if you're looking at stocks. If we do start to see the stocks really sort of trending lower because the uncertainty is just dragging on, which is what tends to happen in markets. If there is a lengthy period of uncertainty, then gravity sort of pulls prices down, pulls risks down, pulls stock prices down. If you start to see things like that, then perhaps that's where you start to think sensibly, and maybe you start using stocks as a long-term trade, start funneling in some money into prices, look at the levels of certain stocks, certain sectors, certain industries, and maybe you just start to put a little bit of cash away into stock markets just for that real long-term trade. Because in between, when you're talking about trading indices or forex markets where prices just go up and down, then you can't really get on a trend. You can't really step out and say, right, I'm going to buy the euro and sit on it for 3 years. But you can do that with a stock. You can do that with an equity, with a company. So that's the way I'm leaning at the moment with trading, and I've been actually doing that myself in stock markets. I've been picking some of the sectors that have been hit really hard, like airlines, even banks. Banks got hit pretty hard over this, even though the backstops are all there and the support is all there. So I started just scaling a bit of cash into various stocks, and I'm still looking to do that. But in the meantime, all I'm doing when I look at markets now, all I'm doing when I look at the data now is pretty much just sitting there watching, seeing how bad things are, and just trading the levels that I see in front of me. And if it's the short-term range on an intraday basis, so be it. If there's wider ranges involved, daily, weekly, monthly ranges that are coming into play, then we assess those and trade those as we see them. But I'm not expecting to see any big fundamental moves right now. We're all watching the clock. We're watching to see countries like Germany, Italy, Spain, even America, what's going to happen with restrictions being lifted and things opening up slowly but surely. We just have to wait and see what's going on. Obviously, we hope for the best that countries do open up more and that the virus cases do drop and the deaths do drop, because obviously it is a terrible crisis. But as I say, from a trading point of view, it's very difficult. We've just got to look at the charts, pick our levels, see the prices, see where markets want to go, and take it from there. So, as I say, that's my thoughts on what's going on right now at the moment. I wish you luck with your trading. I wish you to stay safe through this health crisis that we've got here, and I hope your family stays safe. And maybe at some point I'll do an update to this video later on down the line. We'll see how we go. Thank you very much for watching.